Are you feeling the financial squeeze as prices across the board continue to rise? You're not alone. Inflation has made it tougher than ever for families to keep up with rising costs, and many homeowners are turning to their biggest asset, which is their home equity, for relief. In fact, over $100 billion in home equity lines of credit were issued last year alone as people look for ways to access quick cash. But here's the catch. If you don't know how home equity lines of credit payments work, you could end up in a debt cycle paying more in interest than you have to. So in this video, I'll break down how home equity lines of credit payments work and how you could pay back your HELOC faster, saving you thousands in the long run. So let's dive right in. Home Equity Lines of Credit 101. A home equity line of credit is a revolving line of credit that allows homeowners to borrow against their home equity. Think secured credit card if you're struggling to comprehend or categorize home equity lines of credit. Just like credit cards, you're given a credit card limit and you could borrow up to that amount and pay the minimum payment or larger payments every single month. Now, credit cards are great, but what makes home equity lines of credit stand out in comparison to a traditional credit card that you would get at a bank is lower interest rates, typically half of the rate of a credit card. Interest-only payments, the majority of credit cards don't allow this. You'll have to pay the interest rate plus 1% of the balance. Tax benefits, if home equity lines of credit funds are used for home improvements, then you can deduct the interest payments off of your taxes. And higher limits. Credit card limits are determined by comparable credit and your borrowing history versus a home equity line of credit where the limit is determined by your home's value. Now, let's talk about HELOC payments. How HELOC payments work. HELOC payments change based off of the loan stage as well as the lender's terms. Here's how they typically work. First, we're going to have the draw period. Now, the draw period is usually 5 to 10 years, and during this time, you can borrow from your HELOC up to the approved credit limit. Now, the cool thing about HELOCs is that most lenders require interest-only payments during this period, meaning your monthly payments are relatively low. Some lenders allow principal and interest payments, which will allow you to pay down your debt sooner. However, the typical option on a home equity line of credit is going to be interest-only payments. Now, during the draw period, if you pay down the borrowed amount, you could redraw as many times as you want up to the credit limit, making this a great option for homeowners across the US. Now, the second stage of a home equity line of credit is the repayment period. The repayment period is usually 10 to 20 years, and it starts once your draw period ends. After the draw period ends, you can no longer borrow more money. The line of credit is frozen, and you are now placed on a repayment schedule for the remaining borrowed amount. Your payments will now include principal and interest, causing your monthly payment to significantly increase compared to the draw period. And this is primarily because your line of credit is converted into an installment loan where every monthly payment is exactly the same until your loan is fully paid off. During the repayment period, your balance must be fully paid off by the end of the term. Here is an example. Let's just say that you took out a HELOC in the amount of $125,000. For this example, the draw period is going to be 10 years and the repayment period is going to be for 20 years for a total of a 30-year HELOC. Now, let's just say that your interest rate on this HELOC is going to be 10% fixed for both the draw period and repayment period. So for simplicity, we'll attach a 10% APR for the draw period and a 10% APR for the repayment period. Now, during the draw period, your monthly payment would come out to be $1,041.67. Now, let's go ahead and round up to $1,042 for simplicity's sake. And this would be your monthly payment for the next 120 months or 10 years. Now, once the draw period is over, you'll automatically be switched over by the lender to an installment loan for the remaining balance, which in this situation would be the $125,000 that you borrowed. And just in case if I lost you, the reason why your balance is still the same after 10 years is because you only made payments towards the interest, quote-unquote interest-only payments, which is the bank's revenue or profit in exchange for the money that you want, which is going to be the $125,000. So after the 10-year draw period, you're going to make equal payments, which will include a portion of the principal balance and interest, which is going to be the 10% APR. So your new monthly payment for the next 20 years will come out to be $1,206. And you will pay $1,206 a month every single month for the next 20 years. Now, it's also important to note that banks love HELOCs because this is a secured line of credit that uses your home as collateral. So the odds of you paying back this loan is high because no one wants to be without a home. Now that you know how HELOCs work, let's go into how you could pay back a HELOC faster and how to save more money along the way. So I'll get right to the point. How you'll be able to pay back a home equity line of credit faster and save money along the way is by doing what's called a cash out refinance. Let me explain. So the reason why this works so well is because number one, you'll have a lower interest rate, and number two, you'll pay more more towards principal even with the same monthly payment. So here's how it works. We're going to use the same example as we used earlier. For simple math, let's just say that you don't have any other mortgages on the property and you have a credit score of 700 or more. Again, your home equity line of credit payments on your repayment loan will be $1,206 a month, and your loan balance is going to be $125,000 starting off with an interest rate of 10% and a term of 20 years. Let's just say that you did a cash out refinance on your property and took out exactly enough to pay off your home equity line of credit. So your loan amount on your cash out refinance is going to be $125,000. Your new rate on this cash out refinance is going to be 7%. And this is just as an example. This is not a quote. If you simply Google search cash out refinance interest rates, it will give you a quote around 7% at the time of me shooting this video. And the new term on your cash out refinance is going to be 30 years. So after plugging in those numbers into this mortgage calculator, which I absolutely love to use, and by the way, the home price is going to be the loan amount. No down payment is going to be necessary because, again, we're doing a cash out refinance. So you'll see the term right here and the interest rate right here as well too, which is going to be 7%, making your new monthly payment $832 every single month for the next 360 months or 30 years. Now on this new loan, your total interest paid is going to be $174,000 and change, making your total cost of the loan just shy of $300,000 with a payoff date of March 2055, because this is going to be a 30-year term. Now, if we scroll down here to the amortization schedule breakdown, the first month you're going to be paying $102 in principal and $729 in interest. Every single month thereafter, you will slightly increase in principal payment and decrease in interest payment. Now, how we will pay back this loan faster and save money along the way is we're going to be taking the difference from our home equity line of credit payments and applying that difference towards our cash out refinance. So let's go ahead and take the home equity line of credit payment of $1,206 minus the payment off of our new loan of $832, leaves us with a difference of $374. If we apply that difference of $374 towards our new loan, that's going to give us a totally different financial breakdown. Let's take a look. So if we take the difference of the $374 and we apply it towards our new loan, our new cash out loan, that's going to bring up our total monthly payment to $1,206, matching our HELOC payment. But take a look at the total interest paid as well as the payoff date. So our total interest paid off of this new loan is going to be $67,434,000, and our payoff date is going to be July of 2038. So if we took our home equity line of credit and we converted it into a cash out refinance with a lower interest rate, you would go from total interest paid of $174,386 all the way down to $67,434. That is a difference of $107,000 with a projected payoff date of 7 years sooner. So by doing this one simple strategy, you would save nearly $100,000 in total interest paid and 7 years off of your loan. So you may be thinking to yourself, yeah, but a cash out refinance costs money. Even with the cost of a new loan in the form of a cash out refinance, let's just say that the cost totaled $5,000, you're saving $107,000 in total interest paid. So all you would need to do is subtract that $5,000 off of the total interest paid, which would leave you with $102,000 in total interest saved, making this a no-brainer and something to consider if you were to take out a home equity line of credit. So as you can see, if you simply flip your debt into a better loan with a lower interest rate, you will not only save yourself a lot of money, but you will save yourself a lot of time paying back that loan. If you're thinking about tapping into your home equity, think of this video before you do so and play with the numbers so you can maximize your savings and your investment. Now, if you're enjoying this type of content, do me a favor and subscribe to the channel and like this video by smashing that thumbs up button. And if you want to see my top 5 picks for a home equity line of credit, check out this video right here. As always, thank you so much for watching this video, and I'll catch you on the next one. Goodbye for now.